flexibility is incredibly important to all employees, including women at this point in time. And it's not so much about targeting women and allowing them specifically flexibility, but allowing the entire workforce flexibility, because women oftentimes have partners. And if your partner has a lot of flexibility, that allows you to work more hours or to do more travel or whatever it may be. We oftentimes tend to say, ooh, we have an attractive labor force speaker, we have an attractive position for you because as a woman we'll offer you flexibility. That's only part of the story I think we need to be telling. We need to be telling a story of flexibility for all laborers and support of the male caregivers as well. This is incredibly important to me as a female in this industry because my husband has always been the more flexible party.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC-registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
So welcome to this episode of The Bull of Wall Street. My name's Tally Leger. I'm the Chief Market Strategist at the Wealth Consulting Group. And as usual, I'm joined by my colleagues and co-hosts, Jimmy Lee, our CEO, and Jim Warden, CIO, or the Jims, as I affectionately call them. This time, our very special guest is my longtime friend, Gina Martin-Adams, the Chief Equity Strategist at Bloomberg Intelligence. Welcome to the show, Gina.
Thank you. Thank you for having me. Delighted to be here.
Well, it's nice to see your shining face again. I know we've been connected for years, but before we came on, I was trying to remember when we first met in person. And I think it was at the 2015 ETF.com conference where we both spoke.
Really?
10 years ago.
Okay. Wow. Okay. You've got a better memory than I do.
Well, and that was, I think, just before you announced, or you were about to announce, you couldn't quite tell me yet, but your next big opportunity, and that's at Bloomberg, where you are now. It was a while ago.
Yeah, I've been here for 8 years, so that's pretty close to the right timing.
Congrats on that. And
thanks.
I know, yeah, over the years, I've written a couple of articles for Bloomberg Brief Economics, and I've made a bunch of appearances on the media side. But why don't you tell us about what you're doing at Intelligence and where it kind of sits in the broader Bloomberg ecosystem?
Okay, sure. I mean, I'm happy to take the advantage of the opportunity to kind of brag about the platform. So what we've done at Bloomberg Intelligence is really created a completely independent, objective research organization inside of Bloomberg, leveraging the power of the tools of the terminal, all of the data, as well as the tools of the terminal to create research. And what my team does is create equity strategies across the world. So we have about 40 people on our team in equity strategy specifically. We're part of a team of about 500 analysts globally now. We cover about 75% of the global investable equity markets. We create portfolio strategies, do analysis on markets, model the equity markets, and really provide a data-based and model-based perspective on the global equity markets, and then create portfolios around strategies for kind of tackling the challenges of the global equity markets at large.
And that's great, because one of the things I appreciate about you, Gina, is that you were a financial economist before you started covering stocks like me. So I appreciate your approach to the asset class. But maybe I'll kick it to Jimmy, so we can try to find out some things about you that we may not already know. But okay. I know before we do, when this episode airs, I think I'm going to get another call from our Bloomberg rep. So maybe we can get a discount, Jimmy. What do you think?
Okay.
We're just talking about that.
There is a cost. No discounts available ever.
Nice to meet you.
Nice to meet you as well.
We're all very good friends of Bloomberg in the sense that I think Jim, myself, Tally, we've all been on some of the media stuff that Bloomberg does. And so taking advantage of that. And I've been doing Drive to the Close with Tim and Carol for several years now. Are you in the main Bloomberg building in New York?
Yes, yeah, we're in 731.
I remember going in there the first few times and saying, wow, look at all this free food and all this crazy stuff.
Yeah,
And then
yeah,
the Bloomberg employees are like, yeah, you can only eat so many chips. So
yeah. But I'm happy to report that that food is available at all Bloomberg offices all around the world,
Okay.
and
it
it
is an
is of
amazing
incredible
building.
diversity, customized
Yeah.
to local cultures. It's really quite something.
I think it's a fantastic building. So we all like Bloomberg.
I've never
Uh,
seen curved escalators before like
Yeah,
that.
yeah.
That's very
Amazing.
cool. Jim's got a Bloomberg in front of him right now that he pinged you on earlier. My job, because I'm a financial advisor, Gina, and while being the CEO of the firm, I started my career almost 3 decades now as an advisor and been doing that ever since. And so, unlike the three of you that are market experts and economic experts and things like that, I'm dealing mostly with clients. And so, my job on our podcast is really to kind of get to know our guests a little bit better.
Okay,
So, I just spent a little bit of time on your bio. But first thing I want to say is one, we are big promoters of diversity, especially for me. I'm a father to a daughter that lives in New York. She lives in Brooklyn, actually. She went to school at Parsons there. And
wow,
while she has no interest in
congratulations.
our industry whatsoever, unfortunately for me, I'm a big believer that especially the financial advisor job for women can be such an amazing career. I mean, before COVID, I was working from home. And so as an advisor, I know that you can balance your work home life, especially if you're a working mother, and as an advisor. And so just I wanted to let you know that we're big promoters of promoting women in finance and into our industry even more. So I want to ask you questions about what you think, being a female executive for so long at a very high level, in different places, what we can do better to help promote that. Before I go
Okay,
there, though, I noticed that you graduated from the University of Florida.
I did. I
Well,
even
I've
have my
got
University of Florida badge folder here.
Sorry, so I've got this shirt on because I married into. You see that between the
Oh
hedges?
my, this is not
So if
fun.
you're a little
This
bit,
took an ugly turn real quick.
sorry, apologize, but I got lucky that I was at the two national championship games, and we got the big game
Amazing.
against Notre Dame here in a couple of hours. Unfortunately, delayed to the lunatic in New Orleans yesterday.
Yeah.
But
Wow.
so, anyways, we got a connection there. But I am a fan of a former football coach of yours, Dan
Okay.
Mullins, who's
Okay.
a friend of mine and is now our new football coach here in Las Vegas because I grew up in Vegas. That's where I'm
Oh,
at
I
today.
didn't know that. That's
Yes.
amazing. I had
He's
no
been
idea.
the member guest partner of one of my really good friends, John Sixente, who works for ESPN and is a member of our country club here. So I've got to know Dan a little bit. Everybody loves him here. So we're happy
Oh,
to
great.
have him.
Okay.
So we got this Florida good connection.
Okay.
So back to the women in finance. What do you think we could do? So we're in a position at our firm to try to promote and hire more females. What do you think about that? What do you think people like us can do to help that more?
Um, I think we've made a lot of progress over the course of the last 2 decades in particular at attracting and retaining talent. I actually think attracting talent is easier than retaining talent at this point in time. It really is about retention. I get a lot of attractive female candidates. I think the trick is everybody wants them, and attaining those candidates over time becomes more and more difficult as they tend to drop out of the labor force still and or can be bid away. So I think part of it is compensation. We need to make sure that we're adequately compensating and fairly compensating our existing female labor force to make sure that we can retain them. We're competitive with the environment with our female labor force. But I also think you've touched on it earlier with respect to flexibility. I think flexibility is incredibly important to all employees, including women at this point in time. And it's not so much about targeting women and allowing them specifically flexibility, but allowing the entire workforce flexibility because women oftentimes have partners. And if your partner has a lot of flexibility, that allows you to work more hours or to do more travel or whatever it may be. We oftentimes tend to say, "Ooh, we have an attractive labor force, we have an attractive position for you because as a woman, we'll offer you flexibility." That's only part of the story I think we need to be telling. We need to be telling a story of flexibility for all laborers and support of the male caregivers as well. This is incredibly important to me as a female in this industry because my husband has always been the more flexible party. I've had quite a degree of flexibility in my positions for the last dozen or so years, but he has inherent flexibility. And that has been much more important than to the stability of our family life. So I think we need to tell the story of flexibility, provide the flexibility for all workers of all descriptions. We should support the men in our labor force as equivalently to how we support the women, and sell flexibility to the entire labor force as a good reason to stay. I think that would make it much more attractive for women. I think also, there is something to be said for having more and more women in positions of power to set an example, to set an aspiration, to set a target goal. And this is another thing that we struggle with. We're still working toward a fully diverse labor force at the higher levels of management and at the executive level. We definitely have much more prevalence of female laborers at the entry and mid-level than we have in the past. We have more at the executive level than we have at the past, but it's still nowhere near representative of the population of the educated labor force. So I think we can do a better job of working to promote the talent from within, breaking down internal barriers, clubs, if you will, that tend to be prohibitive to women, pushing through glass ceilings inside organizations. And I think we're doing a lot of that, particularly here at Bloomberg. We certainly are doing a lot of it, but we can do more of it in the industry at large.
That's great, and I agree with you that I think we've seen a lot of progress. I've been saying to people, that younger people, men and women that want to get into this business. Back when I started, in the '90s, on the retail side, you were either an advisor or a sales assistant. Now we have so many different roles that people could fit into, and I've noticed that we have many more young female advisors and financial planners than we ever had before. We just brought on 2 director level jobs, females that are in the financial planning side of it, that help all of our advisors. So thanks for that. Thanks for your input on
Sure.
it. Appreciate it. It's a big thing for us. In fact, Jim and I were passionate enough to create a model that does gender lens screening and looking for leadership at publicly traded companies to invest into. So we hope that actually as a strategy for us works with investors. I'm going to turn it back over to Tally. Tally, you guys, and you and Jim can go from there.
Yeah, well, Jim, jump in here. Why don't we ask a serious question about economics and markets and equities?
Sure.
Well, so Gina, I noticed you're also a CMT and a CFA charter holder, and so I am, and I recently saw one of your pieces that you put out about earnings breadth, and so this is kind of a new concept of combining fundamental data that CFA folks would look at, but also looking at the trend. And so I'm just curious. I mean, I sometimes grapple with, how do I best blend the CFA with the CMT and look at that and what is working better or worse. Curious what your thoughts are on that, how you blend those two together.
Yeah, it's a great question, and I don't know if there's really a simple answer. What I can say is over the course of my decade, I've created what I call a market health checklist, and that checklist is 17 different independent factors that we have used to identify changes in trend that are emerging. When the checklist is getting more supportive, more of my factors are turning green. When the checklist is getting less supportive, more of my factors are turning yellow and red. And so from this perspective, I think I can best explain how we combine technicals and fundamentals as well as our quantitative analysis. I'll take something like the ISM survey, which has actually been historically a very good predictor of tops in the S&P 500. Emerging tops in the S&P have been signaled by a top in the ISM manufacturing survey very consistently over time. And so this is a good example. I'm simply looking at when it starts to deteriorate, when its 2-month moving average falls below its 6-month moving average, it becomes a negative signal on our checklist scorecard. Earnings breadth is another example of a factor that we've developed that is pretty timely at predicting tops in the equity market. Historically, you find that at tops in the equity market, 80% of constituents on the S&P 500 or so are producing stronger earnings growth than the quarter before. At that point, we seem to reach some sort of full capacity for earnings growth. We hit a breadth peak, and then we start to deteriorate, and deterioration in price trend tends to emerge thereafter. We do this across those factors. What we're doing is generally identifying signals of any description. They may be fundamental, they may be economic, they may be even quantitative, and we identify those signals by their efficacy for predicting changes in market trend. So it is a kind of a nice combination of various disciplines. We run 9 different models for the US equity market alone. All of them are, back tested for their efficacy for predicting some component of the index itself, whether it be a sector rotation or market trend or fundamental fair value, right? So we run a lot of different models, but the checklist is sort of the way that I try to summarize any kind of potential trend shifts coming in the index, and then we do that through the multidisciplined approach.
Let me jump in.
That's awesome. Thank you.
That is awesome. Let me kind of take a step back, and I'll ask a broader asset allocation question. And you're in my feed, so I see some of your updates as well. And in one of those recently, you observed that stock to bond valuations are now negative for the first time in a while. For our listeners here, could you break down that so-called Fed model and talk about what it means? Are stocks expensive, or are bonds cheap, or maybe it's both?
With, and nobody has a great answer for, right?
Yeah.
This is a very attractive topic, but not necessarily an efficacious topic for predicting returns for any asset class. Let me start with that. But historically, what we do is we compare the yield available to you on stocks by inverting price to earnings ratio to get an earnings yield on stocks, and then comparing that to the yield available on bonds. And presumably, you want to command a higher yield on stocks than you do on bonds as a risk-free asset to account for some form of an equity risk premium. But that is a pretty big presumption, right? We're now sitting in an alternative world in which the yield on stocks is below the yield on bonds. At least the earnings yield alone on stocks is below the earnings yield on bonds, or the yield on bonds. That may or may not be meaningful, right? It does suggest that stocks could be expensive. That said, stocks spent the better part of the entire decade of the 1980s, as well as the decade of the 1990s, at a negative earnings yield to bonds. So they were expensive for 2 decades. It meant nothing for changes in price trend, right? What we do find that we can derive out of that comparison is, as you note, either stocks are expensive or bonds are cheap. There is some degree of distortion. Historically, in periods of time in which the equity risk premium was in its current quantile, stocks produced somewhat subpar returns. So at its current level, which is slightly below zero, so a slightly negative yield, not an extreme negative yield, but not a positive yield, a slightly negative yield, stocks have, in that period, in that sort of state, historically produced somewhere between 4 and 6% annualized returns over time. This is quite the contrary to the signal produced by this model back in, call it 2009, 2010, all the way through the decade from 2009 to 2019. Stocks had a very high risk premium relative to bonds. So stocks were incredibly cheap by comparison to the bond market. And in that kind of environment, historically, we could expect average annual returns of closer to 11%. So from that perspective, it gives you a sense of, maybe one indicator would imply that the likely outcome for stocks at this state of comparison to the bond market is somewhat subpar returns over the intermediate return. And frankly, that's what we've had outside of the biggest stocks in the US for the better part of the last year or so, 2 years really. We've had somewhat subpar median equity returns, particularly when you include small caps.
Yeah. Well, I think what I'm hearing is what we know, and that is valuations, it's at relative or absolute, are notoriously poor timing indicators. And these kinds of lopsided valuations can persist for a long time. But Jim, jump in here with another question for us.
Yeah. So last week we had Jim Paulson on our podcast. So I noticed you were at Wells Fargo as well. Did you work with Jim at all?
Jim was on the other side of the business. So I was a sell-sider, and Jim was always on the buy side of Wells Fargo and its predecessor companies. But we did interact on occasion, particularly at conferences. We've done events together in the past. I'm a huge fan of Jim's work. And I think he, set a great example for me, particularly as a young economist and then strategist, working my way through the ranks at Wells Fargo for the first 18 years of my career. So I'm eternally grateful to Jim for his example and contributions to the industry. But yeah, we were on the opposite sides of the business the entire time.
Wow. Small world. It really is. Yeah. So one of the things that Jim said, because we asked him about, that famous quote, like, the worst phrase is "this time is different." And he said something like, well, everything's different. Like
Yeah.
things are changing all the time. And we kind of agreed that the one thing that, well, one of the things that's the constant is human behavior and emotions and how people behave around markets. But I wanted to, going back to what you said about the Fed model and earnings yield, like how have things changed? I mean, I'm just thinking of stock buybacks. I'm thinking of the Mag 7, just the sheer amount of earnings and revenue that's generated from those companies, and the margins are so high. Does that kind of skew some of these, models that maybe we traditionally look at and say, well, the earnings yield is low. Some of these companies are big growers, as you know, and they sometimes don't pay very much in dividends. But just, can you give maybe a little context to that?
Yeah.
Like forward looking?
Happy to, because it's, I think, one of the biggest risks to stocks going into 2025 is actually concentration risk. And I did not say this for the last 2 years. This is something very new for this year, because for the first time in the last 2 years, these companies, in particular the tech, media, and telecom companies, are commanding a much greater market cap share of the index than they are earnings share or sales share. For your perspective, they account for about 35% of overall index earnings, but account for more than 40% of the market cap. They also account for about 20% of overall index sales. So we've gotten to a point where now valuations truly are bloated. Now, a lot of people were saying that valuations were extreme a year ago, 2 years ago, and this couldn't continue. This is the one thing that's changed, is we now are actually paying too much for these companies relative to their true contribution to the index for the first time. But there are massive distortions created, and this is one of the things that's really unique to the last couple of years, is when we look at that earnings yield on stocks, as you correctly identify, most of the excess premium that exists in the equity market right now is in that specific group of stocks. If you take the S&P 500 valuation multiple, for instance, and you decompose it into, the Mag 7 versus the rest, or the tech, media, and telecom industries versus the rest, you look at the equal weighted index versus the rest, you can't find a single metric that would suggest the overall market, excluding this specific group of stocks, is actually overvalued. As a matter of fact, the equal weighted market, S&P 500 even, is trading at a multiple very close to its pre-pandemic 5-year average. So we're just trading at normal multiples. But when you include the S&P 500 tech sector, you're trading well north of any reasonable multiple experienced historically. So there is this unique pocket of excess optimism, I would say, or maybe even excess hiding by investors who don't really want to own equities. They only want to own the best equities, and they're over justifying the ownership of those best equities with a fundamental case that is now on somewhat thin ice. The other thing that we note with respect to these companies in particular is, over the course of 2023 and into the middle of 2024, this group of AI-related companies, we have a whole thematic construct that we've developed where we define companies by their theme exposure as well. And so we have a group of AI-oriented companies that we track, and the AI industries accounted for the entirety of earnings growth on the S&P 500. So naturally, you had people gravitating to this earnings growth, right? They were gravitating to the companies that were actually producing fundamental growth. That changed in the middle of 2024, and the market participants are still starting to catch up with this notion that, okay, what drove stock prices through 2023 and 2024 was a lot of flight into the best performers and the strongest performers in the market in an environment where the rest of the index really wasn't contributing much fundamentally. And as a matter of fact, many of them were actually contracting in terms of earnings growth, especially the energy sector, as you may note. By the middle of 2024, that really started to change. And we saw earnings momentum start to slow down for some of the Mag 7, as well as much of tech and communication sectors. We saw price performance start to distribute, as I'm sure Tally has been all over, given his discipline. The Mag 7 wasn't all equivalently rising. NVIDIA certainly was driving the market in excess capacity in the first half. That's changed a little bit in the second half. We have more distribution of gains. It became a much messier market, if you will, in the second half of 2024. So I think the market is starting to catch on to this idea that we were too concentrated in one theme. We were paying an excess amount for that specific theme. And now that some other themes are starting to bubble up to the surface, some other opportunities may emerge for next year, we could have a distribution of interest and appreciation into other sectors and other themes of the market.
Interesting. Just real quick, Tally, if I could follow up on that. You said, Gina, that some of the money has not come back. And we look at the flows and we see that we're still net negative of equity flows since the lows of October 2022. Do you think some of that money is just waiting for things to kind of naturally rebalance before that money comes back in? In other words, if we see improvements in breadth and small caps, do you see more of that money flowing back into equities?
I hope so. What I will say is I think there's institutional distraction into other asset classes, crypto being the first. I think small caps have played a huge role in this, and I don't want to dismiss the role that small caps have played. Small caps in a bear market up until late 2023 was a huge drag on performance, but small caps have been breaking their way out of their bear market. I mean, obviously it was a really volatile fourth quarter, so forgive me for that, but they've been breaking their way out of their bear market really for the better part of a year. And that hasn't been enough to really attract a ton of capital back into equities. There's something missing, and I would blame two things. Private equity as an alternative asset class, which is becoming increasingly democratized and available to the broad array of the investment community, is not marked to market and therefore perceived as less risky, less volatile in an asset allocation framework. And then also, I think that the risk takers of the world are looking at crypto as a risk-taking asset of greater interest and substituting crypto for equities to a certain degree as well. So I think that there are other asset classes that are detracting attention from US stocks, not to mention just the supply constraints. Very few exciting new opportunities that have popped up in the public equity markets for years. Right? The last time we could think about this was really the SPACs phenomenon of 2021 when we had all the SPACs coming to market and everybody getting really excited about this. This is a healthy condition that we don't necessarily have too much irrational exuberance developing the equity market, but it also is really holding back kind of those animal spirits that you would normally anticipate would really promote public equity investment. We just don't have a lot of exciting opportunities. So, and this is partly because of private equity again. Not only is private equity demanding more in terms of asset allocation, more attention in terms of asset allocation, more capital allocation to that industry, but it also, as it gets bigger, is restraining the natural supply that used to move into the public equity markets that would encourage a lot of enthusiasm for ownership of public equities.
Gina,
and I have felt like we are the redheaded stepchild of the risk-taking asset classes for a while.
So when you say
it just is a very different climate than it was 20 years ago.
When you say private equity in crypto, are you talking about mainly institutional investors? And if so, crypto?
Yeah. Wow. Well, that's what we started to see in the back half of 2024 is through the product proliferation in crypto markets with the evolution of the asset class. It's even starting to be embedded into financial company prices, this idea that institutions can start to get into the game on crypto. I think that as we allocate more attention and more resources to this other industry, it takes away from the appeal of the public equity class to a certain degree. It has been predominantly a retail-oriented phenomenon until the last year or two, and now you're starting to see institutions really drive into the game of crypto, and I don't think that's going to go away now that the SEC is starting to take the handcuffs off in terms of product.
Wow.
So I wanted to go back a bit because I was listening, and you started, Gina, to talk naturally about sectors, and let's go there. So away from the Magnificent Seven and the tech sector more broadly, how should we be positioned from a sector perspective? So looking ahead to this year, the new year, is it cyclicals, defensives, or maybe a barbell approach?
It's in our work, it's currently a combination of the two, although I will say currently very politically prone to risk. So the way that we do sector analysis is we have a sector rotation model. And in our sector rotation model, we include analysis of price momentum, earnings trend revisions as well as valuations across all sectors of both the large cap and the small cap index. Very back tested, quantifiable approach, and it just relative ranked sectors based upon those factors, which has historically been very efficacious to predicting performance. As of the fourth quarter, our sector rotation model had financials, industrials, healthcare, and real estate as the top 4 rated sectors, with the bottom energy and materials, and even consumer discretionary. So it's kind of a combo. It's an odd combo of what many people would consider to be somewhat defensive, but also cyclically oriented industries at the top, and then very cyclically oriented industries at the bottom. Notably, tech and communications are in the middle. They're kind of in no man's land. These are the sectors that dominated the top third of our scorecard up until the middle of 2024. And again, I go back to the point I made earlier. There was a critical moment in the middle of 2024 when all of our models started to turn against this phenomenon of the biggest stocks being the biggest performers into perpetuity, right? It just started to shift. Now, the problem inherent in this model right now is it's just not going to account for change that may occur at the fiscal policymaking decision level. So something like healthcare, for example, could be incredibly prone to policy risk going forward. I think that's largely embedded in valuations now, with the valuations being extremely cheap. Yet this sector is expected to post the strongest earnings growth in the S&P 500 over the next year, and that's why one of the reasons why it's at the top of our scorecard. Financials and real estate are very prone to monetary policy risk. If the Fed does not continue on the path to easing, and we don't see persistent yield curve upward sloping, we don't see some comeback emerge in the housing market, it's going to be really difficult for financials and real estate to perform well. And then industrials may be a little bit less politically prone, but nonetheless subject to potential reversals in the Inflation Reduction Act, even the CHIPS Act, anything that might reduce labor, resulting in high labor costs with respect to immigration reform could certainly impact industrials as well. So we're on guard, but nonetheless, our sector framework would suggest you lean into fundamentals and historically efficacious factors and ignore policy risk for now. We'll see if it works.
Gina, when it comes to sectors, what do you? I know you said tech and communication services is in the middle.
Yeah.
But what do you think about the big large cap tech? What would you say? What in terms of a potential return going forward for the next 12 months? What would you say about tech? That's one thing.
Okay.
Two, what's your personal opinion, even if it's a little different than the house view at Bloomberg? What's your personal view on where inflation is going to be and where interest rates are going to be a year from now?
Okay. On the tech call, we don't do explicit return expectations on sectors, so that's a little bit tricky for me to answer. What I would say is middle of the road on the sector scorecard suggests to me that these are unlikely to be the market leaders over time. They may not also be market laggards, but they may just consolidate the gains that they've had over the last couple of years, allowing for some catch up in other sectors and some attention shift to other components of the market. The biggest risk for tech is not actually that valuations are too high, it's that earnings expectations are far too high. And this is what worries me, is embedded in those high valuations is an inherent expectation that these companies will dismiss what is clearly a deceleration in earnings momentum emerging for 2025 and will continuously beat very, very high expectations. Our models would suggest that currently embedded in tech sector prices is an expectation for greater than 40% earnings growth to emerge in 2025. That's a really high bar for tech companies to achieve. Can they produce 20? Sure. And the analyst consensus thinks they will produce 20, but implied in price is 40. So it's just this battle against expectations that they're now having to fight, which creates a little bit of friction in stock prices and probably suggests maybe subpar returns or mediocre returns, particularly in comparison to the recent past. Now, on the inflation Fed call, this is probably one of the most interesting things to talk about for 2025. I mean, I repeatedly find myself reminding my audiences that there are really two things that predominantly drive stock prices: earnings trends and monetary policy shifts. And notably, what we had in 2024 was this enormously positive reaction to the short-term monetary policy shift toward easing. So much so that we priced in the equity market, at least according to our work, we priced an average policy easing cycle for what is actually likely to be a very short policy easing cycle, because I think the Fed is already pretty close to neutral. Unless we see major deterioration in the job market and the growth indicators, inflation is pretty stable right now. It's not continually moving lower. There's very few signs that it's going to accelerate. It's just pretty stable. So inflation is no longer the big driver here. We've got to now start to focus on growth. And what the Fed is seeing in terms of growth is really only modest deterioration in the labor force out in the employment outlook, pretty modest economic growth going forward. I think they're going to find that they're closer to neutral than market participants believe. And that's probably what we started to price in December is the Fed is probably closer to done with this easing cycle than the market was anticipating. And we've got a ways to go to price that in. Now, will the next step after they go to neutral, which I fully expect to happen in the first quarter of 2025, the Fed will probably move to a neutral stance. Is their next move going to be a tightening or an easing is a much tougher call at this point in time. My sense is that they'll sit at neutral for a little while, but probably will head into another tightening cycle. And that could very much shock the market. But a lot of this is policy dependent. I mentioned the labor market very intentionally because the labor market, I think, is something that we do need to pay attention to in 2025. If we embark upon mass deportations of immigrant labor, as an example, and we do that relatively quickly, as is apparently one of this upcoming administration's priorities, this could have some pretty restrictive labor force implications, which could result in fairly strong inflation in wage once again, which is something the Fed is very attuned to and very keen to react to. So we could be stuck in a situation where we're restricting labor force in an environment where growth is still relatively stable. What does that mean for cost? The Fed probably has to tighten in that instance. But we'll see. I think that there's a lot of questions as to where we are 6 months from now. It certainly isn't the basis of any of our strategies to pontificate as to where we're going to be 6 months from now in order to set a strategy today. We do really rely on real-time indicators for setting our portfolio strategies. So we will migrate as conditions change.
So what you just laid out was basically 1990s playbook and scenario where the Fed cut 3 times, went on hold for a long time. They hiked once, on hold for a long time, and then they went back to cutting rates again. And of course, the stock market was going gangbusters the whole time.
Yeah, I mean, we'll see if they can cut again. I don't know. I think we underestimate how much the broader landscape has really changed in a post-COVID world. And we struggle as a group to sort of account for supply constraints as a component of inflation as well. And the immigration issue is a supply constraint issue. It's about reducing your labor force through deportations, right? That's a supply constraint. It's a labor supply constraint. Tariffs are also a potential supply constraint issue. Dismantling of geopolitical relationships it creates major changes in the landscape for inflation. We are not conditioned for this. Institutionally, all of us have worked in an environment for 40 years of inflation merely being a function of demand. Demand accelerates, inflation accelerates. That was it, right? Because we were in an environment up until 2010 of massive deglobalization. That's changed. It's changed pretty materially, particularly in post-COVID world. And I think we're going to continue to kind of really struggle with what that means. Because if we're contending with persistent potential supply shocks and supply-based inflation shocks, it creates a different reaction function, I think, and also makes it really difficult to predict where things are headed.
That's a good thing. Let's dig into that a little bit, the tariffs and the inflation point that you were just making.
Yeah.
The question is, are tariffs inflationary or deflationary? Because in the 30s, they were deflationary. More recently, Trump 1.0, we did see some one-off increases for things like washing machines,
Yep.
maybe solar panels, but overall consumer prices were flat, very flat.
Right.
So what's your view there?
Yeah, very inflationary at the producer price level, which means pressure on corporate margins. This is the only thing that I think matters from an inflation perspective for equity prices, is not ultimately what the consumer price is, but what that difference between consumer prices and producer prices is, because that's where you get your margin as a company. And if you are constraining supply, resulting in an escalation in producer prices that a company cannot pass through to the consumer, that's margin compression. That's exactly what happened in 2018. That is exactly what created the 20% drop that we had in stocks in 2018, reflecting the tariff issues that emerged in the first half of 2018. It wasn't any ultimate consumer price problem. Companies were unable to pass it all on. It was a producer price problem that was not passed on to consumers. This happened in a different form in 2022. We had a massive inflationary spike. Producer prices skyrocketed. Companies were able to pass some of it, but not all of it, on to consumers. We saw consumer prices increase in that instance, but not nearly as much as producer prices. The result, again, was corporate margin compression, which resulted in a 25% decline in stocks. So I think there's direct attribution of supply constraints to margins, which is really important to what drives corporate earnings. And it's questionable as to how much of that companies just absorb and how much they can pass on to the consumer. But we know in every instance they can't pass it all on.
I don't know if you
And
saw
that's
it.
where you get into trouble as a stock.
That's a nice kind of little walkthrough and primer on the mechanics there. I don't know if you saw it, but the Liberty Street Economics blog, they put out a review and a reminder of how stocks really did not respond well to the announcement of the tariffs, and it was unanimously negative in hindsight. So my hope is that stocks will be the ultimate barometer for Trump and the success of his policies. And if he overdoes it and the market doesn't like it, he's going to back off.
I mean, it really does depend upon how he utilizes tariffs, right? I mean, what I thought was most interesting is the difference between the campaign rhetoric and already the approach so far, especially with respect to China, where in the campaign we're talking about 60% tariffs on China, and then all of a sudden the narrative shifted to, well, we might do an extra 10%. And it was like, wait, okay, this has really changed a lot. So it seems to me a lot of bargaining and threats that may or may not become reality, and a lot of behind the scenes conversations that are happening. The other thing to consider for 2025, very unlike 2018, no one expected the tariff by tweet coming in 2018. That's complete shock, right? Now we have a precedent. The international community has a precedent, and they've largely been preparing for the advent of this new tariff regime and this new tariff reality. The other big difference is how much Canada and Mexico, how much immigration, how much drug trafficking, and the like are also getting wrapped up into this story this year, whereas in 2018 it was very, very clearly targeted at certain industries and especially at China. So this is a different character than 2018 was. We've been through something before, which always means we're going to react a little bit differently. We can't expect a 2018 type of reaction, but there will be some kind of reaction if we do ultimately see these threats manifest themselves into real actions.
Well, this time around, some of this, I think, has to do with some of the people that are around him. So we got the Musk effect and some of the other business people that he's put around himself, that he's announced as appointees to the cabinet and otherwise, that I would imagine have some influence, right? We know that Trump wants a higher stock market, but in terms of some of the people that he's got around himself depend on globalism to some degree, right? For the success of their businesses and how they might influence that. Do you think that matters? And then, I guess based on what you're saying, it could be very sector specific, right? Very product specific, company specific, sector specific when it does happen or if it does happen.
With that a lot, because I think while these people that are being put in positions of power are more globalist, Trump himself has also stated that he learned from his last administration that he doesn't want to put anybody into a position that he can't just command and control. So we're getting a lot of mixed messages again. He's very clearly stated that he wants people around him that are going to do his bidding, not advise him. And last time, that's where he clearly acknowledges that he believes he made a mistake, is putting people around him that he could rely on their advice. This time, he just wants people to champion his position. So there's a conflict there, right? Because it seems like these corporate titans would have some degree of influence. And so I'm not sure how to square that out, to be completely honest with you. I mean, obviously Tesla is very much struggling in the world of EV today.
Yeah.
I'm not sure if this is a signal that Elon is going to push Tesla into more of a satellites rocket ship kind of company and away from an EV company. Who knows, right? But the EV is certainly not likely to be a big beneficiary of Trump policies. Will Tesla be, though? And its non-EV components of Tesla? Possibly. That seems to be what the market is saying.
Well, should we give her back 6 minutes, or Jim, do you want to land the plane here with a closer?
So I just have a couple follow-up questions, if that's okay, Gina.
Yeah.
We really appreciate your time, by the way. So I'm looking on my Bloomberg a little while ago. I see that the U.S. 10-year Treasury is the second highest yield next to Iceland. So only Iceland is higher when it comes to developing markets, or developed markets, I should say. And then looking at things like the oil prices, someone I think from your team put out that, we could see $60 oil or below 60 because the technicals look like it's just been weakening. So I'm just thinking about inflation, and like that would be good for producers, right? And like it would help with margins. And if rates come down, the dollar's been really, really strong. Does the dollar keep strengthening or does it weaken? Just maybe your final macro thoughts on all those things would be helpful.
Okay, too many questions in one, but I'll try to get them all. I'll start with the dollar because this is a risk that we identified back in early December. Dollar rips of 10% or more have historically resulted in the next 6 months struggle for S&P 500 earnings. So we're now at that precipice. We're right at the precipice of a 10% dollar rip. So this is something we're watching really carefully. If the dollar keeps breaking out, we will start to see multinational disappointments in earnings in the first half of 2025. They won't be comprehensive by any stretch of the imagination. It takes a greater than 25% rip in the dollar to really create earnings distress.
Sure.
But you get earnings wobbles and earnings weaknesses. We saw this in 2018 as well. So again, another corollary, not the same situation, but something to watch is this dollar rip if it keeps going. And I think it's in part a direct reflection of what's happening in yields.
Sure.
This idea that the Fed may not persist in an easing cycle while the ECB is still very clearly on the path of easing, while many other central banks around the world are still easing, the Fed may have to cut their easing cycle short. That creates strength in the dollar, also creates higher yields in the US relative to the rest of the world. So I think those two issues are quite similar and quite related to what's happening at the Fed. And so again, you watch the Fed really carefully. If the Fed does end the tightening cycle or easing cycle, and ultimately goes to neutral, it probably keeps supporting those, especially if big banks are easing. Notably, I was looking at a chart of Chinese 10-year yields, and they've plummeted down through 2%.
Yeah, they're low.
Right, it's just really getting crushed. So really big divergences on the yield and the currency scale can have disruptions for the U.S. Treasury markets. Now, oil, I totally agree with you. Oil falling is great for stocks, and this is something that oftentimes I get into a lot of arguments on. But nonetheless, I think if oil prices are falling, that is suggesting that we really don't have a ton of inflation pressures that are likely to emerge anytime soon. That's very good for the oil users inside the U.S. equity market. Those are more industrial companies, not necessarily techie companies, but nonetheless, they're industrial and consumer companies, consumer staples, industrials, consumer discretionary industries tend to be pretty big beneficiaries of lower oil prices. So it could help this rotation story to have oil prices still declining. A lot of people, I think, misattribute declining oil prices as evidence of weakness in the economy. I don't think that's the case. It's really a story of supply and demand in oil, and they're a lagging indicator in terms of what they mean for growth, but it's great for margin sustainability for some of those companies in the index that are just starting to kind of get their footing in terms of fundamentals.
Hey, Tally, can I ask one more before we wrap up?
Go for
it's something that you said about interest rates and inflation. So when we had Jim Paulson on, his view is that he sees inflation going a lot lower. He sees a 10-year possibly at that. I personally, maybe not these two guys, believe that inflation might be a little bit lower or a lot lower than what people think.
Okay.
And I'm listening to what you said. It's an opposite view, of course.
Yeah.
And I'm not an expert like you, That being said, is there a path to lower rates? Let's say Jim's right about energy, and that could be a little bit lower, which is a big part of inflation sometimes, especially for the consumer. The one thing he said also about stocks, which is great, is that consumer confidence has been relatively low, which might also contribute to why we have so much cash. So many investors I know that I've talked to have missed out on this bull run. They still think the market economy is horrible. I'm like, what the heck? Anyway, is there a way that inflation prints a lot lower than what everybody thinks? And I've been saying this for a couple of years because I studied and spent a lot of time on how the BLS does housing, and housing being 40% of core CPI data, and 50,000 people get called up every 6 months in arrears, and it's old information. And so rents real time in the hottest markets are down for sure. And we know because of the supply and demand imbalance in housing still, because rates are high, some prices are high, but they've been coming down. So if the housing number starts getting in there and such a huge part of CPI prints, could you see a path that inflation gets lower, which causes then the Fed to recalibrate and then lower, make more moves down?
I think you could. I think it's a harder case to make. In my opinion, it's a harder case to make in a world of persistent supply constraints than it has been in the past. I don't think we have put on enough supply of new units, new housing, new buildings in order to perpetuate the downside for inflation. Yes, demand is not strong, but supply is also not ample. And so this is a very different kind of calculation than it was 5-10 years ago. And it's all a direct reflection of the pandemic and the lack of supply that we put on for a full 2 years, and the lack of supply that has come into the housing market for the last 2 or 3 is supply is very stagnant. And until you get to a point where supply is ample and demand is falling, it's very difficult to make an argument that inflation will fall. So that's something I'm looking at, is the supply side. I think that'll be really important across industries. I didn't talk about the housing market, so thanks for bringing it up, but it's a similar sort of argument. Is the supply side of housing is also very different than it has been in the past. There just has not been enough activity, new building activity, nor are there existing homes coming onto the market to elevate supply and suppress inflation. And that's problematic because it's very different than the environments that we've had where we had weak economic conditions in the past. We just have no supply. So you'd have to see supply come on the market, and then you can make an argument for some form of housing price-based disinflation to emerge and push inflation lower.
And that's really a function of rates, though, right? If rates were lower, the builders would buy more land and start doing new permits, right?
Yeah, but it was an anomaly in COVID because where rates were zero and there was no new supply.
Right.
So we're in the offset of that, right? When rates were at their very lowest, we weren't putting supply on the market. Now that rates are high, you have no supply to deplete. So your reaction function inside the economy from rates going to 0 to 4 is very different when at 0, there was no activity, right? That's the big difference in this cycle relative to the other cycles. Is at 0, the economy was shut. The builders weren't going out and borrowing as much as you would have expected. We should have had this incredible excess of supply come on the market when rates were at 0. It didn't happen.
You can actually
it's just
buy
a
a new
unique
house
aspect
now
of the
for
pandemic.
less than an existing home.
Yeah.
Yeah.
She's so smart. I got to ask one last question.
Yeah, because they're the only ones that are out there.
That's what I had to do. There was no existing home to buy, so we bought one.
Do you, Gina, think that we're back to a normal environment of interest rates, maybe money markets and being 3 to 5% range? Do you think we're back?
Yes, I think we're really close to neutral.
Wow.
A normalized rate right now. I don't think we're anywhere near tight.
Alrighty.
I mean, I think we're really close to neutral.
That's why I love markets. You're going to get as many opinions as you have people on them.
That's right.
There's always something changing.
You know what they say about those opinions, but we're going to keep it clean. I think that's a wrap. Yeah, thanks, Gina.
Yes, my pleasure. Thank you.
Appreciate it,
for having me
Gina.
on. Very compelling discussion.
Hers and his, three's company too. Come and dance on our floor. Take a step that is new.